Welcome to Searching for Mana. I'm Malak Alba, the guest host for today's episode. My guest today is Paul Abrahimzadeh. Paul spent 24 years on Wall Street at Citigroup, and now he's a senior partner at 1789 Capital. They're backing some of the most talked about new categories, from AI and data infrastructure to defense tech and even prediction markets. This conversation was recorded in Riyadh during FII Institute just after some really interesting moments in tech and venture that made the timing feel perfect for this talk. What I loved about this conversation is how openly Paul shares the shift he's seen from the way that VCs invest into what 1789 Capital calls patriotic capitalism, where investment isn't just about shareholder value, but about backing companies that strengthen American competitiveness and AI innovation. I'm really happy to be sharing this with you today. This is Searching for Mana.
Here with me is Paul Abrahimzadeh, who is the partner at 1789 Capital. We're going to be diving into Paul's approach to identifying and nurturing high-growth companies, drawing on his 24 years at Citigroup, where he was the co-head of equity capital markets at Citigroup, advising companies on raising capital, including preparing for IPO and major equity transactions. We're also going to be discussing about the firm's investment philosophy centered on the entrepreneurship, innovation and growth strategy, and also the driving force that shaped the companies and founders that Paul invests in today. So, Paul, welcome to Riyadh.
Thank you. Great to be here.
So, congrats on your move joining 1789 Capital. It's been kind of like a big wave for you, coming like from the investment banking side and now delving into venture capital. How was it like so far for you?
It's been exceptional. We've been incredibly lucky. I joined beginning of April. The first trip was to the region, and at that time our assets under management was about $500 million. We're at approximately $1.5 billion. So in just over 6 months, tripled AUM. We've gone from, at the time I joined, roughly 10 portfolio companies, now we're over 25. And what's been most rewarding is a number of companies that I've known for years, and in some cases 5+ years, are now part of the portfolio. These are companies that I knew, admired, saw grow, and develop to commercial scale with exceptional KPIs. I was getting ready to take them public, and now many of them are still private, and they're a perfect fit for our portfolio. One thing that we've done is also augment the profile of the portfolio such that now it's much more oriented towards growth equity. Of the 25 portfolio companies, over 20 of them have scaled revenue and are within, we believe, 12 to 18 months of an IPO, with only a few early stage bets that are more venture capital. So really excited about the portfolio. We believe it's a top decile in terms of quality of the company. And the asset base now at approximately $1.5 billion gives us the dry powder with roughly 50% deployed to still invest in probably another 20 to 30 companies over the course of the next 12 months.
Can you kind of walk us through your responsibilities as a partner at 1789 Capital? How are you able to identify these high growth potential startups, and how can you assess if they're ready even to go to an IPO?
Thankfully, that's my bread and butter. That's what I grew up doing. So I spent the last 10 years, in addition to running equity capital markets, spending time in the Valley overseeing our technology equity capital markets franchise at Citi. So I spent years getting to know the companies, the management teams, the founders, the VCs. So we have a very deep network and Rolodex within this ecosystem to identify the companies. So we start with first principles, which is we invest in N of 1 businesses, industry leaders, very well known. If I was to show you the logos in the portfolio, you would easily recognize over 80% of them, just because they're the big names within their subsectors. We then pick companies that are backed by other leading investors. So who are the best seed and venture capital funds to ultimately give birth to companies that are at the growth equity stage that are commensurate with our portfolio. So we want to partner with the best VCs, and we have a very deep Rolodex and tight relationships with leading venture capital funds. So really that's given us a great vantage point to pick the right companies to put into the portfolio. We're a very small team, to answer your question. We're less than 10 people. And so I was able to jump in and help with both fundraising, which, as I said, tripled, and also now we've had the ability to deploy capital in companies that we know and have vetted for years. So while I'm only less than 12 months at 1789, our knowledge and experience with these companies goes back much longer. In fact, while we were here in April during the time of the president's visit, the prior trip to Riyadh for me was in 2022 with Plaid. And ironically, I was bringing Plaid here as part of the non-deal roadshow. Plaid was the first investment since I joined 1789 in the portfolio, just showing our connectivity with these companies over a multi-year period. So we're really excited about it, and it's still a lot more to do.
You harvest all of the work that you've been doing too, so it's really good to see that happen. And kind of like, how do you see your investment contributing to like the economic landscape in the US, given like that the fund is very much focused on the whole idealism of the American dream about the US prosperity and all this ideology there?
Yeah, well, I think Don Jr. and me did a great job at FII just now articulating our economic supercycle thesis. We believe that the president's actions are taking very clear moves to benefit the U.S. economy. So a couple of key points. Number one, when he came on this trip to the Middle East, starting in Riyadh in April, he left the region with $2 trillion of foreign direct investment committed from the major players in the Middle East. He then followed up with $1 trillion from Europe and then $1 trillion from Asia. It now stands at over $8 trillion of committed foreign direct investment since the start of this administration, so in less than 12 months. If that were to take 10 years to be invested in the U.S. economy, that's $800 billion per year. That's roughly 2.5 percentage points of GDP growth on top of the 2% baseline. There's roughly a $360 billion tariff run rate that is tied up right now with Supreme Court. Once that's released, that's another 1% of GDP growth. So very simply, we think now is the right time to be deploying, because we're deploying when the U.S. is trending at 2% GDP growth. We think into next year, as we've heard from Secretary Bassett and Secretary Lutnick, there's a clear path to 4 to 5% GDP growth, which is exceptional. It's better GDP growth than we've had, excluding a few periods post-financial crisis and post-pandemic. But it is a true sea change in terms of economic growth, which will lead to earnings growth, which will frankly take these multiples that people are talking about being peak multiples in the S&P and NASDAQ. It will very likely make them much more reasonable when you've got more normalized earnings based on this increase in GDP. So those are some of the steps that the administration is taking that are going to benefit the overall economy. In our portfolio, we invest in AI. The president has signed 100 executive orders benefiting AI, again, in 8 or 9 months. It's an incredible pace. And that is why you see so many tech founders in the Valley backing the administration, because they're deregulating and creating an environment in the US where technology can flourish. The last thing, defense tech, which is a pillar in our portfolio, different from a lot of other growth equity funds. Defense tech benefits the security of the United States. It reindustrializes the economy because these companies like Anduril and Hadrian in our portfolio and soon to be Saildrone are manufacturing in the US. But importantly, the president secured 5% commitment of GDP from NATO countries, up from 2%. Going back to President Obama, the US tried to do that and could not achieve it. That is a sea change. That's trillions of dollars over the next decade of additional military spending by NATO allies. And most of those OEMs are going to be US primes that are manufacturing those military supplies. So again, that benefits the portfolio as well. And we're very early in this trajectory on all of those key tenets, which is why we're excited about deploying.
I think you've joined 1789 during a very, let's say, paced moment when all of the legislations that Trump has been issuing have been very much pro-tech and also like pro-economic growth, right? And all the numbers you mentioned are very positive. But now a lot of people, especially analysts, are kind of saying that we might hit the 2008 financial crisis. What's your kind of opinion about that, given like all the kind of hurdles and the war, all of these things that are happening right now? Is it kind of stopping the financial landscape in the US, or is this just a period of time when we see all like this crypto markets, S&P 500 in September, they were very much in the whole red phase era?
I think that the market has definitely gotten frothy to some extent and very much risk on. That could eventually lead to over speculative investing, which could have a pullback. There's no doubt about that. At the same time, for the reasons I just mentioned, I think there are a lot of reasons to be bullish about the U.S. economy. One of the single biggest risks to the United States is over leverage. If people become concerned with U.S. federal debt relative to GDP, that's when you have an environment where you run the risk of the U.S.'s position as the reserve currency of the world coming under threat. Now, the reality is, I would argue there's no other country in the world at this point in time or region where people have more confidence to store value in their currency than the US dollar. So I think we're good for the moment. I think what the president is doing is incredible to take steps to grow the denominator, so grow GDP, and also take steps to try and reduce debt. So that's something that's been ignored for the past decade. The U.S. got downgraded roughly 12 or 13 years ago from its credit rating. That's a concern when that happens, and I think the president's doing everything possible to avoid that. We need that. Why? A, for the U.S. to continue to attract the world's capital. We've got the deepest capital markets, which benefit all of the companies, public and private in the U.S., to have the lowest cost of capital. Without that, you're at a disadvantage. But the U.S. is really attracting all the world's capital right now when it comes to funding growth companies and private companies. So I think at the moment we're in a good position, and the president's doing everything possible to avoid that potential pullback or recession. Every indicator that we're seeing would indicate the economy is going to do very well. So I think from that perspective, we feel really good about the outlook.
Do you think there's a particular sector that's going to be outperforming the other?
I do think we're early in this trend towards AI. There's a lot of discussions, and we have this debate with other funds that we invest alongside about whether we're in an AI bubble. And what's very interesting is a lot of corollaries are being drawn to AI relative to the dot-com bubble. The dot-com bubble was predominantly predicated on internet companies, most of which were consumer-facing. It's a very different business model than AI. Yes, ChatGPT made its mark in the consumer business. And yes, there's competition with Claude at Anthropic and Grok at XAI to win the consumer. At the same time, the potentially bigger market is going to be enterprise. And what we would argue is if you look at technology and you look at enterprise end market businesses, the best analog is potentially software and not internet. So as people talk about AI and is there a bubble, every analog is being brought back to 2000. And what we would say is take a step back, software is 70 years old. It was created with IBM. It has gone through a multi-decade expansionary period where software today is a $10 trillion market cap across public and private markets. It's a $1.5 trillion annual TAM. Software has not had a bubble. It's endured. Why? Because 95% of global enterprises operate using software. They have to. It's mission critical. Right now, there's 10% penetration in global enterprises of AI. So we think there's huge white space for AI to penetrate the enterprise. We think that that's going to ultimately dictate the winners and losers of enterprises. There's clearly going to be a sovereign impact as well, which is why so many countries are talking about the need to invest in AI, because they see if they don't do it, then they run the risk of falling far behind. So yes, AI valuations are expensive. We think they will be justified over time. There's always the potential for short-term pullbacks, but we are still very bullish on that thesis. And we've made a number of investments. We just backed Reflection AI, which is endeavoring to become the leading open weight model. We co-led the Series B with NVIDIA, DST, and B Capital. And we think that companies like Reflection AI are going to really keep America at the forefront of AI proliferation and AI leadership.
I think the whole composition of AI has become more of a rally. Like a lot of countries are trying to, produce the best AI chips. They're trying very much to kind of be at the forefront. And let's kind of go back to the portfolio. You kind of invested into Crossio. It's one of your recent investments. They're kind of building one of the world's largest AI data centers in Texas, which is very interesting. Place. What kind of made you believe this was a great investment, and what does it really mean for America to host, one of the largest AI data centers in the world in the U.S.?
I think we very much look at the opportunity set, the TAM, the quality of the company. The founder is very important. So we spent time with Chase in July. We're very impressed. The reality is with Crusoe, similar to CoreWeave, you're seeing a massive need for digital infrastructure. So in its most simplistic form, the two biggest bottlenecks for AI are obviously access to chips and then access to infrastructure, including power. And frankly, right now, from a pure play skill set at building that infrastructure, Crusoe is absolutely far and away one of the leaders. CoreWeave is now, I believe, a $60 or $70 billion market cap company. I was working on the IPO before I left investment banking. Incredible company, fantastic founders. It's only 5 or 6 years old. And they're being relied upon by many of the leaders in AI to build this critically needed infrastructure. So Crusoe, very similarly, whether it's their project in West Texas or other things they're doing in parts of the country to build AI infrastructure, they're mission critical. And so, $10 billion is an expensive price tag. We think it's justified. We think the need is not going away anytime soon. And it gets back to that same core thesis that AI is going to be critical for both sovereigns as well as enterprises, and the build out of infrastructure to house that AI is going to be, mission critical for all of these companies.
That's very interesting. So when we talk about AI and energy sector, will there be a demand on that as well?
Absolutely. We invest in Base Power, which is led by Zach Dell. Not only does he come from one of the leading technology families in the country, but what Zach is doing for grid optimization to install batteries in new built homes in the United States, starting in the Texas market, to take energy off the grid at night when it's not being utilized, and then use that in peak hours to deliver lower cost power to the consumer, critically important. But it brings up an interesting point, which is there's a lot of talk about the AI impact on power in the U.S. The fact that the U.S. is going to be running a deficit very soon in terms of creation of new power relative to consumption as AI use goes up. I think many of the AI companies are going to end up looking for their own solutions, because it's going to likely become a polarizing topic from a regulatory standpoint, which is the average American paying more for their electric bills because certain people in the economy are utilizing AI. I can see how that may not be seen as fair, and my sense is a lot of AI companies will potentially look for solutions, and there are many of them that are coming out for power generation to become effectively self-help, so that they are creating the power that they need, so it's not necessarily as taxing on the grid. But there is absolutely a focus on the need for more power and electricity generation in the U.S.
So sustainable energy is important.
It is sustainable. I mean, we've looked at opportunities, for example, in things like geothermal. So we're open to new technologies that will lead to more energy and power in the United States. And thankfully, this administration is very much pro-exploring and allowing and deregulating those industries, given the critical need to support, again, Silicon Valley and AI, which is probably America's biggest moat.
Right. There's kind of a misconception between kind of the silver lining between funding very much pro-sustainable project and also funding something that is, like you mentioned, regarding AI and energy sectors. So how can you kind of define your fund in this way, since like you're anti-woke, you're also anti-ESG as well, but that doesn't also mean that you are open to investing into something that can help technology become more sustainable, right?
Yeah, I think, listen, number one, we're America first. And we invest our LP capital to drive very strong shareholder returns. At the same time, we want to reindustrialize the American economy and drive prosperity in the country. So those are our first principles. The reason for the anti-woke narrative is we believe that ESG, while it may have started with good intentions, over the years was convoluted to a point where it was not driving shareholder value. So to the extent that we find a company that has alternative energy sources and has fantastic KPIs that we can invest in at the right valuation and the right structure to drive strong returns for our shareholders, that could very well be a great fit for the fund. But if it's a company that has a new source of energy but has the wrong KPIs and is going to burn cash indefinitely and not become cash flow positive, that's a much more challenging proposition for us. I mean, I look at industries like solar. That would not be a great fit for the fund. It's been a very challenged industry for decades. It's great technology with certain applications, but again, it may not be the right fit for our LPs.
That's very interesting, and I think you mentioned a very fair point, is that you're focusing on shareholder value, and rather than just like a promise that everyone kind of in the market tries to sell that. Kind of very interestingly, your fund also got very much mentioned during Polymarket's recent news. So you've invested into Polymarket in August, the world's largest prediction market with $6 billion in volume this year. So we're kind of seeing this kind of entire category explode, Paul. So you've seen with Kalshi, they raised $185 million at a $2 billion valuation. Robinhood also launched their prediction market hub with Kalshi. And also, basically, Coinbase has announced plans to enter to the space. So do you see prediction markets kind of having their own category? Will there be more than just fintech, or is there kind of like an infrastructure behind it that's gonna, kind of build on top of it to something else in the future?
I definitely think it's bigger than fintech, and Polymarket actually, the first investment predated my joining the fund. So Omid and the team originally invested at $300 million valuation. And then spent a lot of time with Shane, and then re-upped at the most recent $1 billion round prior to the ICE investment at $10 billion. What I would say is, having spent more time with the company and better understanding it, I think it far transcends fintech. I think it is it encompasses AI, data analytics, market making. It's the reason strategically for the ICE investment and partnership. It's the same reason why NASDAQ invested in Gemini during Gemini's IPO. And I say that Gemini, again, what you mentioned with Coinbase and Robinhood, what you're seeing is a confluence of prediction markets that are built on AI that are also incorporating the blockchain and monetized through crypto. You're seeing crypto exchanges going through in the reverse engineering, which is you start with crypto, you can build on blockchain and deliver prediction markets through AI. So you're seeing both sides of this ecosystem coming together to offer a very similar solution in prediction markets. I think the world is going to come to rely on that more and more. The fact that you can understand what the market is thinking on any asset class is truly empowering. I was just saying to the team at Polymarket, the fact that they have the buy-side earnings forecasts for every public company is truly incredible. That was opaque until Polymarket launched that. If you went back 6 months ago, for the prior decades, to understand what the buy side was thinking from an earnings season outlook on every company, you had to manually pick up the phone and call hedge fund managers, mutual fund managers. It was very difficult. It was not great data. Today, Polymarket has the ability to, like a Bloomberg terminal, show you exactly what the buy side thinks on every public company for every foreseeable quarter. It really is shining a spotlight on information that was unaware to the public until now. So it is transformational. It's why you've seen Polymarket go from 302 billion to 10 billion to now rumors of an even higher valuation on a subsequent round. So we're big believers in the category, and I think, again, you're going to see companies attacking from both angles. AI, like the Polymarket, but then also, if you're monetizing the crypto companies will also get involved as well, and the category is just getting started.
Interesting. But is there kind of a risk regarding like having all this information laid back? Like, will retail rely on this information to invest?
They will, but at the end of the day, policing information that investors rely on is difficult to do. I think giving people more information is generally better. It's the reason why you've got full and fair disclosure when it comes to engagement with U.S. regulators and U.S. securities offerings. So giving people the tools to make their own decisions that are more informed is frankly better, I think, than people guessing. You think about all the advantages of the data that Polymarket is offering to the consumer and the investor. I think it's just going to empower them even more.
It's a very interesting perspective, and I think it very goes to the whole ideology of America to have an open market, right? But Paul, there's something very interesting that you mentioned recently in the news, that you've been quoted saying that there's a new super cycle in IPOs. We've seen Klarna, Circle, Gemini. What kind of the driving thesis behind all of these IPOs kind of launching, especially this year? And were there any kind of IPOs you think underperformed? What kind of your take on that? And let's say kind of the strategy here regarding why these IPOs are underperforming. Is there kind of a discrepancy between like the pre-IPO price and also how they're kind of traded on secondary markets?
I think there are two factors. One is you had effectively 3 years post-pandemic where IPO market was shut. And it was shut truly due to a lack of supply, not a lack of demand. But I think given the re-rating valuations, as interest rates went back up, multiples came down, you had a lack of supply, companies figured they would stay private and not suffer the adjustment in mark-to-market by going public. So you had 3 years of no supply, and as a result, the public equity market was starved for new issues. Why does that matter? Because new issues are inherently priced at a discount to their intrinsic value. So it's very beneficial to the portfolios that are investing in IPOs. When you buy at a typical 10 to 15% IPO discount, that augments their portfolio performance positively. So one was lack of supply. The second is, if you think back to the Sequoia letter that was issued in, I believe, 2022, that advised Silicon Valley unicorns to stem their burn and focus on pivoting to cash flow. It was prolific and it was very well timed and brilliantly written. What ended up happening was companies, public and private, took the advice. They dropped their growth dramatically to try and cut the timeline to get to free cash flow positive. As a result of that, what you see right now, evidenced in the public equity market, the top decile of public software companies, which arguably trade at the highest multiple of any sector, are growing at most 30% on the revenue line. Why does that matter? Most of our portfolio is growing 50 to 100% on the revenue line. So when you think about bringing public companies that are growing at roughly 2 to 3 times the absolute revenue growth of the best-in-class public high-growth companies, there's going to be massive demand for those companies. It explains why there have been a dozen or more very high-profile, high-growth tech IPOs just since the summer. And you mentioned performance. On average, they're trading up 75% day one, which is incredible exuberance. And frankly, most of them are pricing either above their original range or revising their range and pricing above that range. Their absolute valuations are either parity or premium to their comps in most cases. And then they're trading up 75%. Now, some have traded off since then, but the reality is the market has incredible demand. Those IPOs I referenced are on average 20 times oversubscribed. So there's no lack of demand. The US capital markets are so incredibly deep. We think we're in the second inning of the reopening of the IPO market for tech companies, which is why I said I think over half our portfolio will be public in the next 12 to 18 months. So we think that this is very well timed to get capital deployed privately, given that you should have realizations in 2026 and 2027. Again, the biggest issue facing similar managers to us in the private market has been a lack of DPI. Distributions versus paid in capital is at an all-time low. LPs keep paying in capital, they get nothing back because there's been no IPO activity or M&A. And we think that's changing over the next 1 to 2 years.
Then how can we solve the problem with Figma? Once they launched and they were trading at a very different number than their pre-IPO. You think that there could be a solution to this?
The private markets are difficult to gauge in terms of a barometer for valuation simply because private trading markets are relatively illiquid. I think that may change over time. You may see private markets become much more liquid than they are today. But the disconnect between private markets and public markets is not new per se. The public market, because it's got the deepest pool of liquidity, is ultimately the best barometer of value. It is truly a weighing machine that sets valuations at what should be an accurate level. And so arguably you could have inflated values in the private market. There's no doubt about that. But I think the trend of companies pricing richly in the IPO market, trading up aggressively based on lack of supply, and then selling off over time, unfortunately that's a factor of the IPO market, in particular when it's somewhat frothy.
Right. That's like the nature of the market, right? So there's nothing much we could do. Paul, on Searching for Mana, we'd like to end this by asking you a golden question. What's your mana superpower? What is something that kind of drives you to invest into these companies that you're doing today, to kind of work at 1789 Capital, to be very motivated that you're right here at this place, helping all these startups go to IPO and also be part of their investment journey?
It starts first with our mission statement, which is doing good for the country. I truly believe that, and I think Don and Omid, did a great job today outlining that at FII and talking about the need to really bring it back to basics and support the country that has helped you get to where you are. So I think that's the first principle. What motivates me to do it, having grown up in capital markets where you sit at the center of capital formation between issuers, sponsors, investors, what's exciting in this new role is I see a lot of corollaries to what I was doing before. I get to spend time with our limited partners and understand their objectives in terms of returning capital and generating returns. I get to spend time with portfolio companies and builders. We had 25 unicorn founders here with us yesterday, talking about what their businesses are doing, who they're backed by, what they see the future as, what are the issues that they're facing that we can help resolve. And that's invigorating. And just seeing change, seeing evolution, and trying to forecast the future, all of that's incredibly exciting, being part of it. And of course, having a great team. As I mentioned, we've got roughly 10 professionals who've been hand-selected because we think they add a lot of value. But when you really bring together that team with strong leadership and a combined vision and mission statement, it makes every day, frankly, more fun than it is work. So that's the superpower.
How would you describe your own superpower as Paul Abrahimzadeh?
Having, again, grown up in capital markets, you have a bit of a role as a diplomat and really managing relations across various constituencies. And I had the good fortune of working underneath some incredibly talented people over the last 24 years who taught me a number of things like tenacity and the importance of maintaining relationships and integrity and being able to ascertain good versus bad characteristics in certain industries and companies. So bringing all of that to bear, I think, is very fortunate. And in that experience, I think, is one that set me up well to help perform that value at 1789.
That's very amazing. Well, thank you so much, Paul, for sharing all these wonderful insights, and we really look forward to see all your portfolio companies grow in the next months.
Thank you. Appreciate it.
Hope you enjoy Riyadh.
Will do.
Thank you for joining us on this edition of the Searching for Mana podcast. We hope you've enjoyed it and hope to see you again next time. Please subscribe to our YouTube, Spotify or iTunes to make sure you receive all the latest episodes as they are released.